Uh, Welcome to our presentation on how inflation impacts your financial plan. This is Quinn Arnold with Arnold and Moat Wealth Management. Today, our presenter, as usual and excellently, is Matt Hilland, one of our financial planners at the firm. For today's topic, as always, we're looking at a few questions that clients had in recent meetings and emails and discussions. This time around the topic of inflation, since that has been in the news and has not been something that we've talked about for a while. So we thought it would make sense to address it in a webinar. Matt will be taking us through a few different items related to what our clients should expect on inflation, especially how it impacts their investments and their overall financial plan. I think it'll be an interesting time to reflect on some of the latest thinking about inflation. Then we'll stay on for questions afterwards. And if you are listening to a recording of this webinar, feel free to email your questions or give the firm a call, and we'd be happy to talk through anything related to the webinar. And because these topics come straight from our client questions, if you have anything that's on your mind and you'd like to know more about it and maybe hear more in a general sense, like more background and everything, Matt does a great job with these. So I encourage you to email me or Matt and ask your question that way, and we'd love to address that in a future webinar. So with that, I will go on mute and we will have Matt go through the presentation and then take questions at the end. All right, Matt, I'll turn it over to you.
All right, welcome and thank you again for attending our webinar this month. As Quinn mentioned, the topic this month has certainly been a popular one for our discussions with clients, and it's certainly something that feels new and has been making a lot of headlines recently. So we wanted to be sure to spend a little bit of time to address it with everyone. So let's get started. First of all, I thought it'd be interesting to start out with a look at exactly where we are today in terms of, inflation and historical norms. While today's headline number certainly seems high relative to what we've experienced recently, it does remain well within historical norms and certainly below some notable periods like the 1940s or the 1970s. And even with this most recent spike in inflation, we're still well below even where we were in 2007. And I don't think, the mid 2000s are really remembered for their high inflation. And so I just wanted to set the stage with this to first try and calm any fears that we are in any way approaching, worrisome or even abnormal levels of inflation. But of course, that hasn't stopped a lot of the scary headlines from appearing in the news recently. This is a couple of headlines that I pulled just from news articles in the last few days. And, a couple of things to take note. First, we've been through a lot of headlines like this, even just in the last couple of years, with trade wars or the stock market crash from the coronavirus pandemic, and maybe presidential elections, maybe civil unrest, and so on. And I hope you recognize a bit of a theme in some of our webinars where we've highlighted these scary headlines. And now, with the benefit of hindsight, realizing that reacting to these headlines is usually about the worst possible thing you can do. And then second, realize that the market has really taken some of this recent inflation in stride, and in fact, maybe reacting a lot differently than you would expect. This is a collection from headlines this week that were published, some of these on the exact same days as the headlines we showed on the last slide there. And just as the panicky headlines were hitting, we're seeing, very normal market conditions. Actually, bond yields have fallen a little bit, which you would not expect to happen if investors, were expecting a sustained rise in inflation, or even were taken off guard from some of these recent inflation numbers. We've seen commodities begin to fall in price. They spiked a few weeks ago. Lumber was the big one that was in the news, and now it's down close to 50% from its highs just a few weeks ago. And, between treasury bonds and commodities, there are literally trillions of dollars that make up these markets. And today, these markets and the big institutions that invest those trillions of dollars in these types of investments that would be really hurt by inflation are certainly not making any long-term changes. We've seen the market and investors operate pretty normally throughout all of this. And so I just like to point this out, which again, that if it was a consensus that we're about to have runaway inflation, a lot of these numbers that you're seeing right now, from bond prices to commodity prices, would certainly not be acting, the way they are right now. But now let's get into the more important part of the webinar: how a rise in inflation, even if it's relatively modest like we're seeing today, could impact your financial plan and your investments. In this webinar, we're going to look at three main asset classes: cash, bonds, and then stocks. And so first here, we're going to take a look at cash. Of course, cash is an important part of your finances, and it's vital to keep, some amount handy. But as far as long-term holdings or a long-term investment in your portfolio, cash is really one of the poor investment choices in a time with rising inflation. Despite that, though, it's regularly a very large portion of an investor's portfolio. Bank of America does an annual survey of their high net worth investors. So this is people worth $1 million or more. And just on average, 14% of those high net worth investors 14% of their net worth was in cash or cash equivalent. So this is something like cash or bank CDs or money markets are also all going to count towards this as well. And cash has consistently not returned a positive real or after inflation return. Even in the last 20 years, which have seen relatively low inflation, cash has led to about 0.5% per year on average loss to inflation. Again, these numbers are averages over the last 2 decades. That 1.4% return on cash is higher than what you'll see today. But remember, 15 years ago, you were getting, maybe 5 or 6% on your cash. And so this is accounting for some higher rates in the past. Today, of course, I think that average is much closer to 0 than 1.4%. But I don't think it's a surprise for many to learn that in general, cash loses purchasing power to inflation every year. And even with just modest inflation going forward, that value of that cash is really going to get hit. This chart shows the purchasing power of cash over time with just 2% inflation. And over a 20-year period, which is even a little shorter than a lot of retirements will be for recent retirees today, cash will see a 33% reduction in its purchasing power, or its real value to you. Now, everyone's scared of the stock market going down, especially when you're retired. But I think it's worth noting here that, the general stock market has never returned negative 33% over a 20-year period. Even if you invested, 1929, right before the Great Depression, you had a higher 20-year return than what you'll see on cash, even with just very modest inflation over the next 20 years. And so while the short-term safety of cash is valuable, few think of their cash allocation as, a near certain way to get negative real return, but it really is. And if we put today's inflation numbers in, it gets much worse. With 5% inflation, you lose almost 2/3 of the value of your cash, or the purchasing power of your cash, over a 20-year period. And so cash is very valuable because it doesn't swing up and down so much like the stocks or even the bonds in your portfolio do. And having a small amount is very important and certainly recommended, but it's almost guaranteed to be a terrible long-term investment. And when it starts to make up, a significant portion of your net worth, and, even worse impact on your investment portfolio in the long term. I think it's important to point this out because cash allocations tend to grow as retirees become more risk adverse. And it's also a very common holding for people that are worried about the stock or the bond market. And yet there are very few investments that really have worse long-term returns than cash does. However, like we said, having some amount of cash is important. So what's the right thing to do with that emergency fund or that amount of money you want set aside for safety? We know that bank accounts and money markets yield just about nothing right now. Some banks have CDs, or especially, maybe some specials on CDs that might get you, a little less than 1% today. But there is one option that works for some, and we find that they're not as familiar investments to our clients. So we wanted to mention them here. I bonds shown here are a type of savings bond issued by the government. They're other savings bonds, the EE series, or those, orange bonds you probably had growing up. Those are more popular. But these I bonds are newer and function a little bit differently than those old savings bonds you had previously. I bonds have an interest rate that changes every 6 months based on inflation. And these have been getting a lot of attention recently because in May, their interest rate was adjusted up to 3.54% after May's inflation numbers came out. And so this is a US government guaranteed bond that is returning about 3.5% today. And that sounds great. And it is, not a bad deal, but know that this rate is not locked in. So if inflation goes back down, interest rates on these I bonds can go all the way back down to zero. Though they cannot go below that. So you're guaranteed not to lose money, unlike some other inflation protection options we'll look at later. But it still seems likely that these will perform better than a bank savings account, and certainly have been recently. There's a couple of features that are important to know about these I bonds, though. First, they cannot be sold within the first 12 months of purchasing them. So it takes a little bit of planning to eventually build up an amount in these, because you don't want to lock away all of your cash for a year and not have anything to fall back on if you need it. And there's also a limit of $10,000 per year per person for purchases. So a married couple can do a max of $20,000 per year. And so again, that's just another reason it might take a few years to convert your cash into these investments due to that holding period and the annual purchase limit. And know that these are not investments that we can buy for you in Schwab. The only way to purchase these is through the Treasury and treasurydirect.gov. On this site, you essentially create a brokerage account with the US Treasury, and you can buy savings bonds and other things like Treasury bonds there as well. We think this is a good option for the amount of cash that you want to hold and have set aside for an emergency. But again, they're not going to grow your money at all in any real sense. Notice that even this rate today that we get excited about, 3.5%, is still lower than that recent headline inflation number. But they should do better at helping you preserve the purchasing power of your savings, more so than just a simple bank savings account. And so moving on, after cash, the next asset that makes up a significant part of your portfolio is probably bonds. As a whole, bonds have done a better job than cash in growing your investments in excess of the rate of inflation. And so looking at that same 20-year period, bonds have returned an average of 4.8% per year, so giving you a couple percent above inflation. And that's certainly an improvement over cash, but because of how bonds work, they still leave you potentially vulnerable to rising inflation if we do see that here in the near future. And that's because bonds offer a fixed payment that does not adjust to inflation. Holders of bonds are still at risk. And so there's, of course, a couple different types of bonds. Most simply, bonds will just pay you a flat interest payment every year. And so if you buy a 10-year treasury, if you buy $1,000 of that bond that yields 3% today, you're going to get $30 per year in interest for the next 10 years. The problem, of course, is that $30 will not buy the same things in 10 years as it does today. In fact, even under low inflation, you might lose about a third of your purchasing power. And so with today's headline inflation numbers, you're going to lose even more than half of your purchasing power over this 10-year period. And so maybe now you start to realize why inflation is such a problem, but particularly for retirees who invest more conservatively in cash and bonds. Everyone's taught that over time, more and more of your portfolio should be in these safer investments as you retire and as you age. But the problem today is that the safer investments yield next to nothing. And if inflation rises, you're going to receive a real negative return in these safer investments. Bonds are obviously an important part of your retirement savings. We would certainly not recommend aggressively moving out of bonds in general. However, there are a few things that we do for clients when managing their money to help protect their bond investments from inflation. But before we get into how we manage portfolios, we wanted to talk about one option that a lot of people have heard of, and that's TIPS, Treasury Inflation Protected Securities. These have been really popular investments lately. This is a headline from Bloomberg earlier this month about TIPS ETFs that are seeing record inflows or new purchases from investors recently. In case you're not familiar with TIPS, they offer investors an adjustment to the value of their bond each year to match inflation, as measured by one of the sub indices of the CPI, or the Consumer Price Index. And so at first glance, these seem to be a little bit like the I bonds we just looked at. TIPS have a certain principal value that gets adjusted over time to keep up with inflation. When you buy a tip, you're signing up for a fixed interest rate, but the face value of their bond will be adjusted every 6 months based on that CPI, or Consumer Price Index data. And a lot of people think that these are going to act in a very similar way to the I bonds, but they're really quite different. And in fact, are quite complex investments. The first thing that many investors do not realize today is that if you purchase a tip today, you're signing up for an actual negative interest rate. This number here was from yesterday's 5-year tip auction, a negative 1.4% return. And what this means is that investors are buying these bonds well in excess of their face value and already anticipating a certain amount of inflation that will happen that will bring these bonds up to a positive yield over time. And so this means a couple things. First, unlike I bonds, a TIPS investor can actually get a negative return if inflation ends up being lower than investors expect in the long run. And so just for example, with this negative 1.4% yield on today's tip, if inflation drops and does end up going away for the next 5 years, an investor in this bond will probably lose something like 7 to 10% while holding this bond. And so the first thing to recognize before you purchase a tip is that you are not solely just buying inflation protection like you might think, but instead you're making a trade-off that inflation will be higher than what other investors have already priced in. So in other words, there's just a lot of speculation that's built into the price of these TIPS bonds. Just for example, the chart shown here is the price chart of a Schwab's TIP ETF fund just from this week. And notice how, this week, once that big scary headline, 5% inflation number hit, these bonds actually sold off quite a bit. They lost a little more than 1.5% in just a couple hours after that headline hit, which is a big move for what's supposed to be a very safe investment in your portfolio. And so, what does that mean to me when we look at this chart and how the tips have been performing? It means that the market was already pricing in this recent inflation number, and investors who didn't have an understanding of how these investments work are now finding themselves losing money on an investment that they may have incorrectly assumed would be very safe and protect them from that 5% inflation headline number that they saw. And so we do not personally use tips in client accounts currently. It's not that they're bad investments per se. They might be very valuable if you have to choose, a single investment to lock up money for a long period of time and guarantee a real return. But that just doesn't describe a lot of our clients or their needs. We're always there to manage and rebalance their portfolio. We can also use many different types of investments. And so we don't see a need for one single investment to put a lot of client assets in and lock up for long periods of time. So instead of tips, we do two things to help protect the bond portion of your portfolio from inflation. First, we keep duration short on our fixed income investments. And what this means is just buying shorter term bonds instead of longer term bonds. This prevents your money from being locked up, in longer dated bonds. If you buy a 20-year bond today, you're stuck with that interest rate for the next 20 years. If instead you buy a 3-year bond, for example, you're still going to get stuck with that interest rate, but only for 3 years. And if interest rates rise after the 3 years, you'll be able to get your money out and be able to reinvest that money into higher yielding bonds that will then be available. Keeping duration short will reduce the volatility of your fixed income investments and also reduce the potential loss in value from rising inflation. And we use diversified bond funds as well. We're never putting all your money into a single bond, like maybe some of these previous examples have shown. The bond funds that we use hold thousands of different bonds, and those funds inside them are constantly having bonds, mature, and then the proceeds being reinvested at today's rates, which will become higher if this inflation really takes hold. We use bonds in your portfolio to keep a certain segment of money safe from the short-term volatility of the stock market. And so while shortening duration does have the potential to reduce returns over long-term bonds, because short-term bonds tend to have lower interest rates usually, that's okay because we're allocating a larger portion of your portfolio and the part that we need for higher growth to stocks, which, as we'll see here next, offer you the best chance for inflation protection. And so shown here, we're now adding the last 20-year stock returns to the number we've seen on the last few slides. And probably no surprise to you, stocks have been the star performer over that last couple of decades relative to the other investments. And remember, this 20-year period does include some time in that little bit higher inflationary environment of the mid 2000s, where we had inflation between 5 and 7%. And also the 2008, 2009 financial crisis falling right in the middle of this period. And so all that considered, stocks have done very well in not only providing inflation protection, but also growth on your investments. But maybe more importantly for the topic of today's webinar, how have stocks done specifically in times where inflation is rising? This is a chart from an article that was in the Wall Street Journal just the other day, showing how often different investments produce real or positive returns after inflation over 1-year periods. This chart is using data from the last 48 years for stocks, commodities, and treasuries, but only 24 years for tips, since they were not created until mid 1990s. And when we look at a little larger data set like this, we start to see that stocks have historically done very well at producing positive returns, even in a rising inflationary environment. 90% of the time, equity investors have come out ahead of inflation over a 1-year period, significantly better than even tips, which you would think would be better, since kind of their whole purpose is to hedge against inflation. But stocks have also significantly performed better than commodities, which are another very popular investment for those worried about inflation. And then, of course, also treasury bonds. And I thought it would be interesting to look at how the stock market in general performed during some of these real notable periods of inflation that we've had in the past, which, of course, is everyone's fear right now, that inflation just kind of keeps going and gets a little bit more out of control. And remember from that last slide that 90% of the time, stocks have produced real positive returns to investors. Of course, that also means sometimes they don't. And so I wanted to look at when they did not, just to give you an idea. After World War II, the US saw really high inflation just for a couple of years. In fact, a lot of people are equating today's environment to be a bit like the post-war 1940s, where it just took some time to get the markets back to normal, but was not really any structural long-term, runaway in inflation. Anyway, 1946 saw inflation running about 8.5%. And during that year, stocks returned about a negative 8%. So not great, but hardly outside of, kind of normal stock market fluctuations. The early 1970s are certainly the most notable, and in the early 1970s, stocks really did struggle. Inflation eventually approached double digits by 1974, and stocks, I should say this is stocks measured by the S&P 500 here, lost nearly a quarter of their value in 1974, and that's 1 year after losing 14% the year before. And so, a lot of people are familiar with these numbers. They know how bad the 70s were for investors. But stocks performing poorly in inflation is certainly not the rule. Shown on this slide now are returns in other years that also saw very high inflation. Note specifically, many of these years have even higher inflation than, those years on the previous slide. Remember on the last slide, we showed those two terrible performing years in the early 1970s. Well, as inflation continued to rage on at the end of the decade, and actually as inflation got even higher in the late 70s and early 80s, stocks actually performed quite well. Just look at the bottom line there in 1980, when inflation peaked right around 13.5%, stocks actually returned more than 30% that year. And so it's certainly not the rule that stocks perform poorly in inflation like many believe just by, making assumptions about those couple years in the early 1970s. And so what is the right way to invest your stock allocation now, knowing that inflation could be around the corner? We might be sounding like a broken record here for some of you we know, but inflation is not a reason to make big dramatic changes to our investment portfolios. We invest very broadly in diversified stock funds that, invest you in many companies that should do very well in inflation, and also international and emerging markets, which may be spared from inflation, if inflation hits in the US. And these are also funds that are rebalanced over time so that if inflation does cause the value of some of these funds to drop, like we saw in the 70s, we'll have other assets that should have done well over that time that we can sell and then purchase the investments that have done poorly and take advantage of that future rise in value, like we saw in the later part of the 1970s and early 80s. And so, despite what a lot of people will try and say, inflation cannot be predicted with any amount of certainty. Even Warren Buffett, who's usually regarded as one of the better investors of our lifetime, at least, told his shareholders in one of his annual reports that it's foolish to try to guess which stocks or which companies will outperform over a short period of time in an inflationary environment. And so the main point we wanted to show here was the way that we construct portfolios and invest client assets will help protect you from inflation over time. Your investments give you a lot of ways to protect you and to protect yourself from inflation, and we put those options to use when we manage your portfolio. We face a lot of uncertainty when we invest, and inflation is really just one of those risks. We know that it can be scary to invest in times like today, but hopefully this showed you just how important sticking to your plan can be, and specifically how important that stock portion of your investments are going to be over the long term, and not only providing growth, but also protecting you from inflation. For our long-term clients, that the portfolios you're in have gotten you through the 2008, 2009 crisis, and more recently through the coronavirus crisis. And that same investment philosophy is also going to get you through a period of rising inflation, if that indeed does come. And so that's all we had prepared for today, but we'll stick around to answer any questions you have. Thanks again for attending, and have a great weekend.